Are mutual funds better than individual stocks? This was a question that was brought to me a couple weeks back by a subscriber, and the short answer really is that both can be used to achieve your financial goals. However, there are differences between using individual stocks and mutual funds for your investments, and we'll go over a bit of the nuances of each and the cases where you might actually prefer one over the other. Now, for this discussion, when we talk about mutual funds, I'm going to talk strictly about all stock or equity mutual funds. Mutual funds can hold a variety of investments, including cash and bonds, commodities, and other assets. But in that case, it wouldn't be an apples to apples comparison to individual stocks. So for this video, when I say mutual funds, I mean a fund that's comprised of individual stocks. Now, as for similarities, whether you're investing in a mutual fund or in individual stocks, either way, you're investing that portion of your money within stocks or equities. Because of this, in both cases, understand that your principal is at risk and there's no guarantee of future performance. In both cases, you can see a lot of significant short-term price volatility, but over the long run, purchasing stocks at reasonable prices has done well for investors. Let's go over some of the differences and which cases you might be better suited to one or the other. If you decide that you want to purchase your own individual stocks instead of relying on a mutual fund, you'll have more direct control over which companies you're investing in. If you're investing in a mutual fund of stocks, particularly a passively indexed mutual fund, you don't have direct control over which stock the fund invests in. In this case, the fund might invest in stocks that you think are overvalued or that you don't personally believe in the company. By investing in individual stocks, you can pick and choose and only invest in the companies that you really believe in or you think are undervalued. Additionally, you can avoid investing in stocks that you have no interest investing in. Personally, for me, I think there's a lot of stocks within the general market that are relatively overvalued, and that's part of the reason that my investment strategy is more actively focused on selecting individual stocks, which I think provide a better value than just passively buying an index mutual fund in the market. Now, your perception might be different, but that's just one of the cases why someone might prefer to do individual stock investing compared to just simply picking a mutual fund. However, on the other hand, picking your own stocks takes a lot more time, and it's a significant larger amount of effort than simply picking a well-diversified mutual fund. In this case, if you're a person who lives a very busy life and simply doesn't have the time or the interest to research and pick your own individual stocks, then you may be better off going the mutual fund route. In my case, I personally enjoy and find value from researching stocks and trying to find opportunities in the market, but I do understand that I do spend a good portion of my weekends and some of my weeknights researching and looking at these stocks. It can take a fair amount of time to get to the level of understanding on a specific company where you feel comfortable and confident investing in it. Multiply that across many different stocks and you might find it's just simply too time consuming to pick individual stocks for your case. In that case, mutual funds can be an effective solution for you, which allows you to invest without the need for you to spend time selecting each individual stock. Now that brings us to our third difference, which is with investing with mutual funds, specifically passive index funds, the performance of your stock investments are going to closely mimic those of the general market. Now what this means is that your portfolio isn't going to significantly underperform the market. However, it won't have any chance of significantly overperforming it either. However, over the long run, this might not be a bad thing because the majority of active fund managers tend to underperform the market over long periods of time. However, just know that when you're using mutual funds, particularly index funds, when the market goes down, your portfolio will go down as well. Some of you might have experienced the financial crisis of 2008-2009, and it's not a great feeling when your investments go down 50%. Investing in individual stocks, on the other hand, doesn't give you any guarantee that your performance will be any less worse. However, it does give you a little bit more flexibility for you to pick the most compelling investments that you think have less downside risk than the rest of the general market. Value investing strategies and defensive investing strategies tend to outperform the market during bear markets or corrections. If you want more flexibility in advance of a market downturn, individual stocks might provide that option for you. On the other hand, if you're comfortable not looking at your statements during a bear market, then investing in a mutual fund and index funds could be an option for you as well. The fourth difference comes down to diversification. When you're picking individual stocks, it's on you to make sure that you have proper diversification. While it might be tempting to load up on shares of Facebook, Amazon, Netflix, and Google, understand that your portfolio won't have a lot of diversification outside the technology sector. Compare that to mutual funds, which typically have diversification across companies of many different sectors and industries. Now, I should note that while this is generally the case, it's not always the case for mutual funds that are targeted specifically towards certain sectors or industries. Given that, you should keep in mind the context of each of those mutual funds within your portfolio to make sure overall you have some diversification across different sectors. When investing in individual stocks, this is something that could be easily overlooked, and it's an issue many investors came to realize firsthand during the burst of the dot-com bubble, when new internet stocks were all the rage and some investors loaded up too heavily with these speculative stocks. Now, there are a few other differences, but those are some of the big ones that come to mind. So if you're going the mutual fund route, how can you approach that from a practical standpoint? Well, one way you could go about it is simply to use passive index funds that track the market. Now, I've done a video about that, which I'll link in the card above and in the description below, so you can check that out if you want to get a little more detail. Another option, which is an adaptation of using the passive indexing strategy, is to use these passive indexes as the core of your portfolio and then to add portfolio tilts. Now, what these tilts are is basically an addition to your core passive portfolio, but adds an additional weight to some sector or segment of the market. This could be a tilt towards technology stocks, a tilt towards small cap value stocks, or a tilt towards real estate investment trusts. In this case, the core majority of your portfolio is still passive indexing, but you do have this additional component. A third option is to use actively managed mutual funds where you have a fund manager that selects the stocks that goes into that portfolio. Now, in this case, I think it's important to understand both the objectives of that fund manager and also understand the fees that come with active investing. On the fees, the most important number will be your expense ratio, which is expressed as a percentage. In this case, this is the annual fee that's paid as a percentage of the assets you own to the fund manager. The way this works in practice is assuming, let's say you have an expense ratio of 1%, if that fund usually gets a dividend of 3%, you would only be credited 2% in your distributions because 1% of that would go to paying the expenses of the fund. Over time, these expense ratios add a significant amount of opportunity cost to investing, so it's very important to keep that in mind if you decide to pick an actively managed mutual fund. Personally, in my view, most of the times the cost associated with these actively managed mutual funds is not offset enough by additional benefits that come from investing in these funds. Whether that's the case for you is your decision, but that's something to keep in mind. As for investing in individual stocks, the world is really your oyster. With enough cash, you have the flexibility to create a portfolio of stocks however you see fit. In this case, that can be somewhat of an overwhelming task, and some questions that come up are, well, which stocks do I choose, and how many should I have in my portfolio? In the case of which stocks you should buy, I'm assuming that as someone who's interested in investing in individual stocks, you have an investment philosophy. Now, basically what this is a framework for how you can think about these types of investments and how you should decide whether or not to invest. For me, as a value investor, I try to look for stocks that appear undervalued in the market and offer asymmetric risk-reward opportunities. These would be stocks that over the long term, I believe have limited downside risk, but good potential for reasonable returns. Now, there are many different ways one can determine value from a stock, but I'll save that for another video. The key here is that if you're going to be purchasing individual stocks, you need to have an investment strategy and a framework for thinking about and making investment decisions. As for how many stocks, that really comes down to a personal preference. Understand that the fewer stocks you have, the more significant your portfolio will be impacted by the move of any one of those stocks. This can be both in the upside direction, but also in the downside direction as well. For this reason, it's generally advised you don't have all your money in a single stock and spread it out across several stocks. On the other hand, the more stocks that you have in your portfolio, the more time it'll take to keep track of each one. While you might be able to get very in-depth and have a great understanding of 10 stocks, that'll be much more challenging to do if your portfolio consists of 30 stocks. Additionally, the more stocks you have across diversified industries, the closer your performance will likely mimic that of the market. This over-diversification can mean that the amount of time and effort you're putting into your investments won't translate to significantly different performance than that of the general market. Now, obviously there are exceptions to this, but those are just a few things you want to keep in mind when deciding how many stocks you want to have in your portfolio. Now, there's no magic number for how many stocks you should have in your portfolio, but for me, I'd like to have at least 6 to 8 as a minimum to feel diversified across different sectors, and I'd probably feel the need to cut back on the number of my positions if it got anywhere close near to 20. Again, this is very dependent on the individual, and there's no magic one-size-fits-all solution for everybody. Now, I just want to go over a few common mistakes that can happen when you're doing both styles of investing. So when you're investing in mutual funds, one mistake you can make is to ignore the question of asset allocation. Now, when I'm referring to mutual funds in this video, I'm referring to all stock mutual funds, but understand that there are other classes of assets that you can invest in. It's important to diversify not just within stocks, but also within other asset classes as well. Keep this in mind when investing and make sure you have some cash available to invest in non-stock assets. A second mistake is thinking that more mutual funds you buy, the more diversified you are. You might hear stories about a person who buys every fund in their 401k thinking they're extra well diversified because they have 30 funds. Well, in some cases, they might actually be less diversified than someone who just picked a single index mutual fund. It all depends on the actual individual stocks that each of those funds ends up buying. In this case, splitting your investments across many different mutual funds can make it a real headache to really understand even what you're invested in. So if you're going to invest in mutual funds, keep it simple and pick only a few funds that you understand and can keep track of. And the third mistake is ignoring the cost of fees. If you do go the actively managed mutual fund route, understand that that expense ratio is going to add up significantly. This is one of my issues with robo-advisors because even a relatively small management fee adds up to a significant amount of opportunity costs over a long time horizon. Make sure you understand this before you invest in these funds. For investors investing in individual stocks, one big mistake is to ignore the transactional cost of all these trades. Fortunately, if you're in the US, there are free brokerage accounts you can use like Robinhood that eliminate this cost. However, if you're not using a commission-free brokerage or simply don't have access to one, understand that these transaction costs for each buy and sell of a trade can add a significant amount of cost, especially if you have a relatively small amount of capital to start with. Another mistake that's easy to fall into is overtrading. And this also carries over to the third mistake, which is lacking a long-term mindset. If you don't have a long-term mindset and an investment strategy going in, it's very easy to fall into the habit of overtrading on stocks, especially during large price movements. Not only does this increase your transactional costs, but studies have shown that the more you trade, the lower your performance tends to be over the long term. Have a long-term mindset, know your investment strategy, and keep it simple. So I hope that helps answer your question. Both can be used for great success as an investor, but some might be better suited to your financial situation. If you got some value out of this, you can leave a like or click the notification bell, or if you're really cool, you can do both. But either way, thank you for watching. My name's Michael, and I will see you all in the next video.